10-minute delivery of bread, biscuits, a bottle of shampoo, and a packet of tea bags existed even a few decades back during my growing up years. But that meant me having to run an errand to the nearest kirana, which is a mom and pop grocery store, to buy the stuff my mother had ordered for. The kirana stores, a handful of them in every neighborhood, were the bedrock of growth for the largest FMCG companies back then. Rather, they were at the core of India's retail ecosystem. They offered convenience, affordability, and accessibility. But today, these soap to staple sellers stare at dwindling profitability. They are facing threat from the rise in quick commerce and the changes in their supply chain network. A strong supply chain network and deep penetration were the moat for the largest FMCG behemoths. In my early days as a research analyst, I have heard the managements of HUL and Dabur elaborate on how their presence at even the Panwala stores helped. But with the rising e-commerce sales, such penetration is no longer a factor that can safeguard companies with the biggest reach and brands. Rather, startups and companies with more affordable offerings have had an edge over the FMCG behemoths, especially thanks to their unique e-commerce marketing. This also means the FMCG giants can no longer afford to pay hefty distributor commissions or keep spending on old supply chain networks. So the situation has left leading seasoned FMCG players such as Dabur, Marico, HUL and Godrej Consumer Products grappling with the challenge of balancing loyalty to traditional distributors and simultaneously adapting to the growing demand for tech-driven solutions. To add to that, the rise of 10-minute delivery quick commerce platforms is rapidly transforming India's retail landscape. As per industry estimates, approximately $1.3 billion in sales is expected to shift from the traditional kirana stores to the digital first mode over the next 2 years. Entities such as Zomato's Blinkit, Swiggy's Instamart, Zepto, Big Basket, and JioMart are extremely bullish on their growth prospects and their ability to cannibalize on the relatively muted online presence of the FMCG behemoths. Meanwhile, the larger FMCG companies that reported problems in their trade networks have swung into action by streamlining their inventories. Dabur, for instance, acknowledged the challenges faced by distributors. The company's management highlighted that the increasing share of alternate channels has put pressure on the profitability of distributors. In response, Dabur has undertaken a one-time strategic initiative to rationalize its inventories. Consumer goods giant HUL stressed on the importance of growing its presence in the distributor network while also tapping into high-growth segments such as quick commerce. The company is focusing on premium products to maximize growth across different regions. The HUL management flagged that the core focus remains on maintaining strong ties with kirana stores and traditional distributors. After all, being the industry leader, HUL derives two-thirds of its business from general trade. So even though the kirana stores located in metropolitan cities have borne the maximum brunt of digital sales, not everyone is giving up on them. Kirana stores may continue to remain integral for FMCG stocks as they remain a dominant channel in tier 3 cities and beyond. They offer companies an extensive reach to consumers who may not have access to modern trade channels or e-commerce platforms. Of course, supply chain is not the only hurdle for FMCG behemoths. They have plenty of challenges on the cost inflation front too. Most agriculture commodities have experienced a rise in prices over the past year. This has impacted FMCG companies such as Dabur, HUL, Nestle, Britannia, Marico, and Tata Consumer. Be it wheat, barley, sugar, coffee, or copra prices, the companies have not been able to pass them entirely to consumers. Further, the government has recently increased import duty on edible oil to support domestic producers. So, FMCG companies are considering adopting new cost saving initiatives, optimizing supply chains, and exploring product mix adjustments to mitigate the effect of the rising input prices. Therefore, despite the warnings that quick commerce is out to kill the moat of the FMCG giants, these entities remain well placed to leverage India's structural growth trajectory. Several categories of essential FMCG products in India are still underpenetrated and underserved. Additionally, ongoing rural penetration is further contributing to the sector's growth potential. With the rise in income levels, as Indian consumers experience a rising purchasing power, the tendency to opt for premium and branded products will grow. Such premiumization will be the key driver for overall growth of the FMCG sector. But there are two important reasons that set FMCG stocks apart for investors. Return ratios, which is the return on equity or the return on capital employed. Dividend payments. At a time when most other sectors are flirting with the risk of minimal growth in volumes, thinning profit margins, and the tendency of balance sheets accommodating additional debt, the FMCG companies continue to offer best in class return ratios. The sector stands out for offering shareholders the best return on invested capital consistently in the most challenging environments. Dividend payouts also play a part in this. FMCG companies are typically rich in cash flows, having negative working capital, and are generally generous with dividends. So, even the years during which the stocks may underperform benchmark indices, the dividend yield of the FMCG stocks manage to keep investors satiated. These factors contribute to safeguarding capital over the long term. Therefore, there are more than one reason to be optimistic about the long term future of India's best FMCG stocks, despite the near term gloom over their quarterly earnings. Nevertheless, it is never a good idea to go blind about valuations. Here is the FMCG heat map for your perusal. Despite the recent corrections, the P multiples of the top FMCG companies continue to remain at elevated levels. Only in few cases have the stocks seen a time correction, that is, the prices of the stocks have remained stagnant for a prolonged period. So, while it is a good idea to start getting greedy about FMCG stocks, one must stay cautious about valuations from a longer term perspective. Hope you like this video. Thanks for watching.